The fall of a Kiwi icon, the fight to revive the Warehouse Group. Kia ora. Today we are presenting on the Warehouse Group, one of New Zealand's largest retail companies. Founded in 1982 and listed on the New Zealand Stock Exchange since 1994, the Warehouse Group operates major brands, including The Warehouse, Noel Leeming, and Warehouse Stationery. The company has built its identity around affordability and helping Kiwis live better every day. We chose the Warehouse Group because I personally have worked at the Warehouse for several years. When at the Warehouse making sales and putting out stock, I noticed that we weren't actually making very much money. I would put out a classic 1B5 book and the store would lose 50 cents. Now, at this point, I hadn't taken this class, but I knew that maybe losing money when selling wasn't the profit margin they were looking for. This made me interested as a stakeholder in investigating how the warehouse was actually performing. Was my summer job going to be there next year? These results made us realize that the Warehouse Group needed a change if it wanted to remain the Kiwi icon. This led us to the strategy of disinvestment.
Looking deeper into the Warehouse Group's financial performance, we found that profitability has become increasingly weak over recent years. Although revenues have remained reasonably stable, net profit margins have declined significantly, averaging 0.925% over the last 2 years. A major issue affecting profitability is rising operating expenses. These include lease costs, employee wages, depreciation, and other operating expenses. Wage pressures have been particularly important, with New Zealand's minimum wage increasing from $17.70 in 2019 to $23.50 in 2025. Because the Warehouse Group employs a large workforce, even small wage increases create major cost pressures across the company. At the same time, the Warehouse Group has faced growing competitive pressure. Following COVID-19, companies such as Temu and Shein entered the New Zealand market and began capturing market share through extremely low pricing. IKEA's arrival in the New Zealand retail in late 2025 is expected to create even more pressure, particularly in homeware. To respond to these challenges, the Warehouse Group has adopted a disinvestment strategy. Rather than continuing to diversify, the company sold underperforming companies like Torpedo7 and planned to close the market to reduce losses and focus on its strongest brands. This strategy also reduced capital expenditure requirements. Instead of investing heavily in new ventures, the Warehouse Group now primarily focuses on maintaining existing stores, improving efficiency, and supporting e-commerce operations. Overall, our analysis suggests that the Warehouse Group strategy is less about growth and more about financial survival.
For our financial forecasting, we projected that the Warehouse Group's future performance over a 5-year planning horizon using historical financial data and current market conditions. First, we analysed revenue growth. Between 2016 and 2025, the Warehouse Group experienced relatively sporadic revenues, but still maintained an average annual revenue growth rate of around 0.7, despite economic shocks and competitive pressures. Next, we forecasted operating expenses. Historically, operating expenses grew at an average rate of approximately 1.66%, driven largely by inflation, rising wage costs, lease expenses, and utilities. Since inflationary pressures and wage increases are expected to continue, we projected operating expenses to increase about 1.7% annually over the next 5 years. We also forecasted capital expenditure remaining relatively low in future years. Following the sale of Torpedo7 and the closure of the market, future capital expenditure is expected to focus mainly on maintaining existing stores, replacing outdated assets, and making smaller operational improvements. Finally, we analysed financing activities. The Warehouse Group currently has both short-term and long-term financial obligations, with much of its long-term debt relating to lease payments. These lease obligations are expected to continue, increasing with opening of 2 new stores in 2027. However, despite these liabilities, the company still has access to available funding through its bank facilities and has continued meeting all lender requirements. This suggests that while the Warehouse Group is financially vulnerable, it is not currently facing immediate financial danger.
For our cash flow projections, we focus specifically on incremental cash flows, meaning only the cash flows that change because of the Warehouse Group's disinvestment strategy. The 2025 annual report confirmed the sale of Torpedo7 removed approximately $13.2 million in annual losses, while the closure of the market removed a further $8.5 million. Combined, this eliminated about $21.7 million in yearly losses. Because these closures were reflected in the financial year 2025, the benefits were already built into our starting projections. Without the disinvestment strategy, the losses across the 5-year forecast would have been significantly worse, showing the strategy was necessary before any recovery could occur. To test the reliability of our projections, we also created a more conservative scenario. In this case, revenue reduced from 0.7 to 0.3, while operating expense growth increased from 1.7 to 2%. This reflected a stronger competitive pressure from Temu and Shein, alongside rising wage costs. The conservative predictions showed how financially fragile the Warehouse Group currently is. Net cash flow became negative from financial year 2027 and continued worsening up until 2030. Since all the investing and financial assumptions remained the same, these weaker results were caused entirely by revenue growth and higher operating expenses. Overall, our analysis shows that while the disinvestment strategy was an important first step, there still needs to be a reduced in cost of doing business and improved efficiency if it wants to remain financially sustainable in the long term.
To check whether the disinvestment strategy created value, we first found a discount rate using the weighted average cost of capital, or the WACC. Using the capital asset pricing model, we got a 4.5% risk-free rate, a beta of 0.77, and a 5% market risk premium, which resulted in a cost equity of 8.35%. The cost of debt was the company's borrowing rate of 5.23% from their 2025 annual report. And since the Warehouse Group is loss-making, we didn't apply the tax shield with 20% equity and 80% debt. This gave a WACC of 6%. However, we also tested a tougher 15.65% rate to be cautious. The main cost was a one-off $60.5 million loss from selling Torpedo 7. But by selling Torpedo 7 and the market, the Warehouse Group avoided $21.7 million annually, which resulted in them getting a net present value of $30.9 million, an internal rate of return of 23.3%, which is above their 6% WACC. And their payback period was also 2.8 years, and they also had a profitability index of 1.51. Now comparing it to the tougher 15.65% that we also did, the net present value also stayed positive at $11.1 million. So this means that the disinvestment strategy still clearly creates value and should continue. The Warehouse Group has about $849 million of debt and $211.6 million in equity, which mentioned previously is 80% debt and 20% equity. Much of that debt is lease liabilities, mainly from them leasing most of their stores in New Zealand. Net debt rose from $50.7 million to $96.1 million in a year. But they still do have $353.9 million of available funding, and they still meet all lender requirements. But because of the debt, and because it's still rising, it still limits their flexibility. We think the Warehouse Group should gradually reduce their debt. Normally, debt offers tax advantages, but because the company is loss-making, it can't use those tax shields, so the risk of high debt now outweigh those benefits, raising the stress risk and flexibility limitations. The Warehouse Group faces ongoing pressure from stagnant revenue and faster rising expenses. While this investing cuts $21.7 million annually, it only delays cash flow strain rather than fixing the long-term problem. Base projections show positive cash flows weakening over time, while conservative models turn negative rapidly due to high cost and demand sensitivities. So can they be saved? Yes, they can. First, they should continue with the disinvestment strategy. It still creates value. Secondly, they should focus harder on cost control to slow expense growth. Third, they should reduce debt to minimize risk. And fourth, they should invest more in the core brands and not in non-core businesses. Thank you.